Okay, Jeff, let's talk about mining financing now. You've talked about some of the issues facing the industry in regards to finance. Can you elaborate on those?
Well, I think there's several things. First off, the mining industry is extremely cyclical. The mining industry has a history in the minds of many investors of not necessarily providing the kinds of returns that investors seek. But much more important than anything inherent to the mining industry, there are major changes going on in the way money is managed on the buy side, on the investment side. Institutional investors are shifting away from investing in individual companies. They're much more interested in AI-driven investments, either in index funds, ETFs, and things like that. And there's a greater amalgamation of money in the hands of investment management companies, so that what you find is a lot of these companies say we cannot afford to spend the time looking at individual smaller cap companies, which most mining companies are, and it behooves us to work on ETFs, mining ETFs or index funds, rather than do that. And really, I mean, in the last year or so, that might have changed. It may have changed, but over the last 5 years or so, these index funds have outperformed the managed funds that focus on individual companies. So there's a shift in the buy side of the finance market away from investing in smaller companies and individual companies, and that has been reducing the amount of money readily available for mining investment.
Well, what about the actual fundraising done by the mining companies this year? For example, many miners I've spoken to have said that they've never had it easier when it comes to raising capital.
They have had it easier. It's very cyclical. One of the things that we saw in past cycles is that a rising tide raises all boats. And when the gold price rises, or when metals prices rise in general, or commodity prices rise in general, or you have banks touting a marketing hype with the commodity super cycle or something, investors tend to throw reason to the wind, and they will invest in anything that has gold or mining in its name. And you see a lot of companies that have been very good but starved for capital all of a sudden be able to get capital. And you see a lot of companies that should not be financed all of a sudden get all the capital they need, simply because investors will throw money at them for a year or two or three because of the cyclical strength in the products.
Yeah. You and I talked about ETF flows a couple of weeks ago when you were on the show. When we see a lot more interest in the sector due to maybe a higher gold price, which is what we saw this year, do we typically see money flow into the funds, the ETFs like you talked about, or directly into specific companies?
Well, the ETFs I was talking about a couple of weeks ago were the metals ETFs, and they have in fact distracted investment funds away from the individual companies. And you'll find some gold miners who complain that the creation of the ETFs 20 years ago, we started talking about them in 1999. The first ETFs came out in like 2004, 2005. So it's been like 15 years of them, and there has been money that's been redirected to the ETFs. And then there are the ETF mining ETFs too. And you are seeing more money go into those and less going into specific companies. And if you think about it, when you invest in a company, that's capital formation. When you invest in an indexed fund of companies, that's not capital formation. That money is not going to those companies to develop their companies. It's going into the stock market, into a pool of casino-like funds.
Right. So what you're saying, this is a vicious cycle, if I understand correctly. Investors are investing in these funds that are not contributing to capital formation, that's not helping them explore, and in doing so, long-term, their investments will go down anyway.
Right. And it's not limited to the mining industry. I mean, the mining industry has its own issues that cause problems, but it's across equity markets. So if you look at the stock market, the U.S. stock market is the best example. It's 46% of market capitalization of all stock markets, and it's been rising steadily from 2010 into this year. We had some hiccups last year and this year, but it's still at record levels, right? But if you look at what's been going on, a big part of the increase in the stock market has been decapitalization. Last year, companies spent more money buying their own shares on the New York Stock Exchange than investors spent buying those shares. That's decapitalization. That's companies saying, I'm making profits, and rather than investing in hiring people or building new factories or buying new equipment, I'm going to buy my shares back, which pushes the share price up by skewing the supply-demand balance. That's decapitalization of the U.S. economy. Stock market looks great, but the U.S. economy and all of those companies are actually being starved for capital. And that's been one of the major factors driving the stock prices higher for the last decade. It's not a healthy increase in the stock market.
So what is this going to lead to, Jeff? Is this going to lead to a major correction? Is this going to lead to investors just staying out of the space? What's going to happen next?
It's hard to say. I mean, there's several trends. First off, there's any number of people who are pushing very hard to shift money away from the public markets into the private equity industry. They feel they have a lot more control and a lot more power in private investments than public investments. And you are seeing that. You've been seeing that for 20 years, and it's probably going to accelerate. I think that you have major issues in terms of capital formation, not only in the United States, but in other parts of the world. And it's going to be a problem for decades to come, not years to come.
Yeah, I think part of the problem is, part of the marketing mantra of funds is that it's difficult for individual investors, especially if they're not professionals, to pick individual securities and outperform in broad index, and therefore just buy an ETF is probably better for you long term. So is there any way that mining companies or maybe any other company in the S&P 500 could compete with this growing trend?
I hate to say it, but I mentioned the rise of private equity, and there are any number of people who, out of pure greed and avarice, are proponents of private equity. But private equity actually is a big solution. If you look at the gold mining industry and to some extent the other mining industry, you look at ASARCO and copper mining in the United States, a lot of mining was not financed by large institutional investors pouring money in. It was financed either by families, the Guggenheims in the case of ASARCO, or by smaller fund management companies. And I think that the gold mining industry has overlooked the fact that it can get all of the capital it needs, at least the smaller and medium-sized gold mining companies, from smaller investors who are still fundamentally and macroeconomically driven. And they don't need to try to chase those big funds.
Okay. Jeff, thanks very much for your thoughts. That was a good talk.
You're welcome.
Thank you for watching Kitco News. I'm David Lin.